Hey, you guys. So I'm just over here waiting on YouTube to pop on. So I'll be live over there too. And I'm hoping that you can hear me. The only challenge is I'm not able to check myself over on YouTube to see if the volume can be heard. So hold on, let me try to run over there, maybe a blank screen. But tonight I want to share with you who am I? I'm Garlinda Price with Fusion Insurance Group, and I want to do something that I haven't done in a while, and this is Insurance 101. And I have some notes so I can stay on course. Look, I wrote them out so we don't get sidetracked. And these are just things that are like FAQs that pop up all the time as I'm meeting with clients and questions that come up. And people tend to ask the same thing. So I was like, well, I should just do a video about it. So hold on, I just need to log on over to YouTube and make sure I can hear myself over there. How are you guys tonight? I hope you're having a great start to your week this Monday. It was such a beautiful day outside. Okay, so it says that I'm live. Just checking to see if I can hear me. I unmuted, but I don't know. Well, let's hope so. So if anybody happens to pop on over on YouTube, the chat is open, so you'll be able to chat. And then, so shout out to you all over here on Facebook. So let's get started. So we're talking about Insurance 101. And so again, there's so many things that pop up. I own Fusion Insurance Group and so many questions. And Marvin and I, shout out to my husband, Pastor Marvin Price Jr., AKA Lamb Chop, my Lamb Chop. I lovingly call him Lammy for short. And we talk about all the time things that people just don't know, right? That they may or may not know, and that they don't know until sometimes it's too late, right? So these are some things I wanted to talk about, and I want to share with you what are the concerns of most people that I talk to. Now, I do specialize in whole life and final expense, but I sell all insurance. So whether it's term life, whole life, annuities, IULs, you name it, in the insurance, health insurance, dental, vision, you name it, we sell it, right? Hey, Kibro, I love you. But this is the main concern that I hear pop up all the time of the people that I get to connect with and that I've met. One is they are concerned with leaving a burden to their family. Everybody tends to have the same fear, right? Leaving a burden to their family. Let me make sure I cut the volume off. Yeah, so you should be able to hear it. But everybody's concern is leaving a burden or being a burden to their family when they pass away. The second thing that people are most concerned with is outliving their money, right? Getting, because people are living longer now. So people are worried about outliving their money or running out of money. And so people have the same concern. And then the third thing that I would say people share a concern with is affordability, right? Being able to afford the insurance. And I will share with you, and there's no way to church it up or clean it up. The older you are, the more it costs, right? But there, and I don't want to say there's necessarily a way around that, but we just have to adjust our mindset sometimes to costs, right? Because if we've waited until later in life to get insurance, there's some insurances that we no longer can qualify for based on age, just because the age cutoff is a certain number, or financially, right? The cutoff is a certain number. What do you do about that? You do what you can do, right? And so and you meet with a professional, a licensed life professional, life insurance, health insurance, investment professional that can say, you know what, this is where you are, this is where you want to go. Let's create a plan to get you as close to possible as where you want to be. You may not hit the mark of what you wanted to do when you were in your 20s or 30s, but you can hit the mark of what you want to do when you reach 70 or 80. What if you're beyond 80, but you're still in great health? Well, let's help you hit your goal to when you hit 90 or 100. Let's stop putting a timeline to stuff, right? I found out that age 65 is really not retirement age. I was listening to, I forget what it was. Marvin and I were talking about it last week, but yes, it technically is retirement age, but the reason why it was created was based on something that had nothing to do with age. I think it had something to do with Social Security and and the money that was available to people when they reached a certain age, but it literally had nothing to do with, oh, you're 65, now you should go sit down somewhere, right? Because now people are living longer, they're working longer, they're more active. I talked to us, I'm gonna keep going, I'm gonna get back to the notes. I talked to a 75-year-old earlier, and he's still working out, lifting weights, riding bikes, and looking for insurance because he realizes he's gonna live longer, right? He's expecting to live longer. So that means there's an expectancy that you're going to need more money, right? So people are concerned about leaving a burden. They're concerned about not dying with debt. I find that most seniors that I talk to, or people that I talk to that are over a certain age, they do not want to leave their bills unpaid. My parents are in their 80s. And then I think the lady I was talking to, she might have been in her 70s, and she was adamant that she did not want to leave her credit card debt or her mortgage debt or her medical bills or her financial burdens. She didn't want to leave those on her son, right? My parents are like that. They're like, they want to pay off their debt before they pass away because they don't want to leave a burden. Even though those bills don't necessarily belong to the child, they do stay with the estate, right? So oftentimes people think, well, when I die, you don't have to pay it. Somebody else will pay it. Well, that doesn't actually work like that, ma'am and sir, right? It goes to the estate. And I remember when I filed as the administrator for my brother's estate, you have to go put an ad in the newspaper. And when you go to put the ad at some point during probate, unless you have a trust, if you have a trust, you don't have to worry about any of this, right? I don't think. But when you go, when as his administrator, I had to go put an ad in the newspaper, and then ad had to run, I think, for 90 days or something like that. I'm telling you, the minute that the ad hit, we began to get I'm not collection, but creditor letters. You know, your brother owes this or they owe that. And it was all these letters. It was very overwhelming, right? And so I understand why people are like, they don't want to die owing anybody money, or they don't want to die and leave a burden on their children. Because guess what? If you are the executor of the estate or the administrator of the estate, or you and your siblings are working together, you're going to get the letters. Trust me, it's stressful. Okay. So how can you avoid that? Now, mind you, you don't have to pay it. But if you don't pay it, there's some things that could happen that tie up the money in the estate, depending on how the family member has it set up. You know, so you just want to know. So carrying on, insurance 101. This is what you want to think about. So there's term life and there's whole life, right? So let's talk about term life insurance. After you pass 55, max 56, you can't qualify for a term insurance product with most carriers. There are some carriers that you can qualify for a term life insurance policy for over the age of 55. They are more expensive and they are going to require underwriting. What does that mean? You're going to have to do blood and urine. And the reason why you're going to have to do blood and urine is because they're looking to disqualify you, not purposefully, and I say that kind of sarcastically, but why are they looking to disqualify you? Well, at 55 and 56 and older, they're assuming that you potentially have some underlying conditions that are hereditary to your family. And they want to look at your blood work and your urine to see, are you predisposed for certain diseases, certain illnesses, certain sicknesses? And so they can tell that from your blood and your urine. They're going to request your medical records, right? So just know that if you decide, and there's nothing wrong with that, because what is the insurance company in the business to do? They're in the business of deflecting risk, right? They already have an actuary that has done all these numbers and looked at all this data, all this information to say most people that fall within this group of age or this group of people are going to have this issue. That's how they determine pricing for insurance, right? So if you're over 50, normally if you're over 45 and you ask me about term life insurance, I'm going to ask you, what's the goal? Why do you want term life insurance? Like, is someone, what's the word I'm looking for on here? Who is depending on you financially that you want 100,000, 200, 300, 400, $500,000, $1 million in life insurance? Who is depending on you financially, or what are you trying to accomplish that number is so important to you? Because maybe we can achieve the goal, but not with term life. Maybe we can achieve the goal with a different product, right? Or maybe it's just not possible. And I have to have the honest conversation to say, you know what? That's something that probably would have been better at a different age, but here's where we are now. And here are the products I recommend. And this is why. Okay. So term life insurance is great for young families, people that are younger. that have a mortgage that the sole breadwinner is the wife and the husband are the sole breadwinners, or they're the main breadwinners for the home, and they have big expenses, car payments, mortgages, children's tuition, private school. They have all these different things. This is just customarily. That doesn't mean that there's not other reasons why people might want term. I'm just saying what we generally see, right? It's normally from people that have mortgages. And so they need a large amount of money to pay off the mortgage in the event the breadwinner dies, right? So that means the family's not completely uprooted and the whole financial house is blown out the water and now everybody has to move, right? So that's what term life insurance would be good for. The other thing about term life insurance that may not be a benefit depending on how old you are, but it's still a great product, right? Just depends again on your goals, and everyone's goals are different, is that it only lasts for 10 years, 15 years, 20 years, 25 years, and 30 years. Those are the increments that you can buy it in. 10 years, 15 years, 20 years, 25 years, 30 years. So why would somebody get a 10-year term? Again, to make sure that they have enough money to cover themselves. Maybe they own a business. Maybe they're going to sell in 10 years. Maybe they only have 10 years left on their mortgage. Maybe they have a 15-year mortgage. Maybe they have a 30-year mortgage. Maybe they own 20 years left on their mortgage, right? So it could be all these different reasons. Maybe they have mortgages on different investment properties. It's so many different reasons. But the thing to know about term is it's going to end, right? It's going to go away. So a lot of times when people come to me and they're a certain age, welcome to all of you that are watching. Thank you for being here. So I always share with people that are a certain age, what is your goal? Tell me what you want. What is your financial plan look like? What do you need this money to cover? What do you want it to do for you? Right? Because that money for term is not renewable. It's not, I mean, not, it is renewable. It doesn't provide you with cash value. That's what I was trying to say. And it's going to go away. It's going to end, right? So depending on what you tell me your goal is, I may tell you, well, Kiana, term might not be the best thing for you to do because it's going to go away and you wouldn't have accomplished your goal, right? And I want you to hit your goal, right? So whole life, what is that best for? Whole life is a really great product because it goes the whole life, right? Now you can get term coverage or whole life on anyone from ages 0 to age 85. Miriam and Caleb and I, we were all laughing about this and determining who is 0, right? 0 is a baby that's under 1 year old. Right? So they're 0 years old because technically they're not a year old, right? So we can cover people from 0 to 85 with whole life. Term life, you can get covered anywhere from 0 to, I think it's 70 might be the max with one of the carriers that we write with. I think it goes up to age 7. Okay. And so what a whole life policy does and why I think I'm a whole life fan. I think it's just a really great product. I think it does a fabulous job of making sure that there's protection in place for people because it goes to age 120. And with a lot of those policies, you make your last payment around 80 or 90, depending on who you're writing it with, right? And so I just think that whole life is a phenomenal product. Here are the reasons why. One, it builds cash value, right? Number two, and it takes about 5 years for the plan to start building cash value unless it's paid up insurance. But for the most part, once you start making your premiums, it takes about 5 years for the cash to start to accumulate. But once it accumulates, you can do two things with this cash, probably more than that, but I'll say 2 or 3 things I can think of. One, if you hit a financial hardship and you're not able to make your payment, if you check the box for the automatic premium loan option, when you got the policy, if you had a great agent, they told you this, then that means if you have a financial hardship and you're unable to make the payment, your cash value can make your premium payments until you get back on your feet. Right. The second thing that it does is it builds cash value so you can borrow your own money. Normally it's around a 5%, 5.5% interest rate. All policies are different. I'm just giving you an example, so don't quote me on that. That's just what I've seen in some policies, right? So you're borrowing money from your own policy at a 5% interest rate. which is really cool. Now, it does take away from your face value, but nevertheless, you're not going to the bank and borrowing their money at 15% interest. But guess what's going to happen tonight at midnight? At midnight, the bank is going to take all the money out of the account. And guess what they're doing? They're investing our money in insurance. They are the biggest investor of life insurance and investments across the globe, right? So why not invest your own money in your own policy and have your own and be your own bank, right? So when you're talking about and seeing people talking about being your own bank, they're doing that with whole life insurance, and they're doing that with index universal life. They're doing it with indexed annuities. So we'll talk about that. We'll just breeze over it, but we'll talk about it a little bit. Okay. The other thing that whole life does is the premiums don't go up, right? So with term, you can have regular term that's level. You can have term that's renewable. And I forget the other kind, but with renewable term, that means, let's say every 5 years, it has to renew. It could increase in price to the point where it becomes so affordable that you like cancel the policy, right? But they do have level term. So with whole life, your premium doesn't change. It stays the same from the day you get it. If you're 0 years old, all the way to 120 years old, as long as you don't let that policy lapse, you always have the same premium. So let's say my children started out with a $11 policy. If we never cancel that policy and we don't stop making the payments, when they're 56, they'll be paying $11 for that policy, right? So I love whole life for that value. You can borrow against it. It builds cash value. The other thing is, if you have a whole life policy on a family member and they die naturally, it pays one amount. But if that family member dies in an accident, meaning something that was not their fault, a slip and fall, they get in a car accident, they get, unalived by somebody else, right? That policy doubles in the event of an accident. And I mean, that's just incredible to me. So then whole life comes in standard. There's different terms, but standard whole life, which is the average person. Modified whole life, which is, hey, we're going to give you whole life coverage, but based on your health history, we're going to modify the terms that you applied for, and you'll know, and this is what we're going to offer you. Graded is if someone just has, they're in poor health. They have cancer, maybe they have a poor health diagnosis, maybe they're just on so many medications, maybe they're currently in the hospital, maybe they were in the hospital, but they're going to be offered a graded policy, which means for the first 2 years, 3 years, or 4 years, whichever company the policy was written with, their beneficiary would get back 110% of all premiums paid into the policy up until the time that the wait period is over. And then once the wait period is over, the full face value pays out. So if they die 2 years and a day and there was a 2-year wait period, their family would get the whole amount. But guess what? With a whole life policy, in the event they died in an accident during the waiting period, the family gets the full 100% of the face value. So I just think it's just a really great policy. Now, the other thing that I think is really cool with some whole life products is that they include what we call value added benefits, or VAB, right? They include your casket, your vault, your headstone, or your urn, your vault, and your headstone in the event of your death, in addition to the premium payment. And they have a special team that will call and negotiate the funeral cost on behalf of the family, so that the family's not just walking down to the funeral home saying to the funeral director, hey, here's our policy, right? So instead of you going down to the funeral home saying, here's my policy, you have a designated wish team that will call on your behalf, negotiate on your behalf for your family, get the cost of the funeral down so that more of the money can stay in the family's pocket. The funeral home doesn't even know how much you have, right? So we're talking about just insurance 101. What if you own a business? What if and then you can have multiple policies, right? Let me just say that right quick before we talk about business owners. You can have multiple insurance policies on yourself, on your family, on your children, just not at the same carrier. So let's say you wanted 2 or 3 whole life policies because you have a goal of, you really want $100,000 in coverage, but maybe because of health, you can't get a term product. Then you could get multiple whole life policies to add up to $100,000. You can get term life as high as $50,000, right? So if you had two $50,000 whole life policies, that's $100,000. That's so funny. A bunch of balloons just popped up. I don't know where that came from. Right? You can get $100,000, but it doubles in the event of an accident. So you technically have $200,000 in coverage. So that's another thing that I think is really awesome. You can have multiple policies on yourself, your children, your family members. Let's talk about insurable interest, and then we'll go to business owners. As long as you have an insurable interest on someone and that person is aware of the policy, you can get policies on people that are blood related to you. Okay, so whether that's a mom, a dad, a sister, a brother, a cousin, right? You can even get policies, I believe, on stepchildren. Um, don't quote me on that, but I believe on stepchildren and on adopted children, as long as you have guardianship forms. Okay, and you said that was cool. It was, and so you can get, you just have to have insurable interest. You can get insurable interest on a business partner, right? So we're going to talk about business policies real quick next. And I think that is so important when you own a business, especially if you're in a partnership, right? You got to make sure that that person, in the event of their death, that because when they die, if your business partner dies or someone that's really important to your business, your secretary, your assistant, your admin, if those people die or something happens to them, it really impacts the way that your business runs, right? Because if there's someone that manages your calendar, they manage all your appointments, or they do your lead generation, or they do your social media, they are valuable to your business and to the operation and the operating of your business. So if you own a business, you need a policy on yourself, you need a policy on your team members, and you need a policy on replacing your income if something were to happen to you or something and you couldn't work, right? You want to get a policy that potentially has living benefits. Let me write myself a note. We'll talk about that right quick. But as a business owner, if you have a key employee, like your top salesperson, your top professional, your top whatever it is in the office, and you know that they are a significant part of the income that comes into your business, you need to get a policy on them. And I would do it like ASAP, right? I remember when I had a business partner when I first launched the company, and he was such a really great guy, but God just was like, Garlinda, I did not tell you to have a business partner. But if we would have stayed together, I would have had a policy on him. Why? Because he did all the lead generations for our short sales. He managed all the short sale files. He managed all the short sale contracts. And so if something would have happened to him, oh my gosh, it would have put a dent in our business, right? He had all the contacts with the banks. He had all the contacts with the asset managers. And so he literally was worth over six figures to me in the business. And so if you're a business owner and you have a partner or you have a team, you want to get insurance on the people that work for your firm, that work for your company, that work in your business, or make it where such they get a policy and then you name the business as the beneficiary. Okay. Maybe you have a church, maybe you have a ministry, and the pastor doesn't have insurance, or you don't have insurance on that will replace or be able for the church to withstand itself and stay afloat in the event something happens to your executive pastor, your senior pastor, your youth pastor, right? You can get policies as a business because the church is a business. I'm not talking about the spiritual side of it, but the administrative side of it is a business, right? And so part of your church's or your ministry's succession plan or your nonprofit's plan would be to be able for it to continue on in the event of the death of the person that runs it or the people that are responsible for different segments of it. Okay. So that's where insurance comes in, and it can play a key role in making sure that the organization is able to sustain itself. What is a living benefit? There are policies where you can add riders, right? So you can add riders to an insurance policy. Let's give an example of a nursing home rider, right? Let's say, God forbid, somebody gets into an accident and they have to have time or have to be put in a nursing home. You have a rider that will cover your nursing home expense. Let's say, God forbid, they get into an accident and they're unable to perform two or three of their daily living functions. I think that's called critical illness, right? So with the chronic, I'm sorry. So with the chronic illness, that means that they're unable to perform two to three of their daily living daily living functions, bathing, eating, and feeding themselves. That means they need someone to help them do that. you can add a rider that would take money from the face value of your policy that you could use 50% of the face value of your policy for your for your expenses to pay for someone to come in and help for care. Right. And then there's critical. So there's critical, chronic, and terminal illness. Critical illness is, God forbid somebody has a heart attack or they have cancer. They have heart attack, cancer, and stroke policy riders that you can put along to ride along on your life insurance policy. And if you have a heart, I don't want to speak to you. If someone has a heart attack, if they have a stroke, if they get diagnosed with cancer, and they submit that to the insurance carrier, immediately the insurance carrier, within whatever timeline that the insurance carrier designates, and they've looked at records and files, let's just say within 30 to 90 days, they're going to cut a check in the amount of whatever the policy was that you purchased for the rider. Let's say it's a heart attack. There was a client that had a heart attack. This is one of my other business partners. And when their client had a heart attack, they received $25,000. What could they use it for? Anything. It was because they had a rider on their policy that said that if they had a heart attack, they would get a policy payout to them of $25,000. They didn't need to die to get it. Right. So I think a lot of times that's why this is called Insurance 101. I think a lot of times people think that insurance is only for death. No, there's living policies, there's living benefits, there's dental insurance, right? What if you want to get some, what's it called? What are the pretty white teeth called? Honey, what are the white teeth called that everybody gets? Veneers. Thank you, Kayla. What if you want veneers, right? There's insurance that you can get to help assist in the cost of your veneers. What if you just want to keep your teeth in your mouth, right? You're like, oh my gosh, I need extra dental insurance. Then you can get a dental insurance policy as a rider. We have health insurance. You can get health indemnity plans, because what if your health insurance from your job isn't enough to cover everything? Then you can get an extra health insurance policy, right? So if you're a business owner, I just think those things, and even if you're not, if you're just an individual, I think that it's really important to think about and to know about everything that's out there. So you have your nursing home rider, you have your grandchildren and your children's rider. So let's say you're on a budget, right? And you're like, okay, I can afford my policy, but I need to be able to cover my children and or my grandchildren. Well, they can ride along on your policy literally for probably like $4, right? I know with one company it's just $4. And so when you think about that, like that means that instead of you spending additional money for them to get their own individual policy, if your budget is tight, I do recommend each person have their own individual policy. But if your budget is tight and you're like, okay, can I add my kids to my policy? You can, and they can ride along on your policy until they're 26 years old. That's really cool, right? But now this is the challenge. When they turn 26, they got to get their own policy. They can no longer ride on yours. The downside is if you die, their insurance goes away, and then they have to get coverage. They're no longer covered, but then they have to get coverage at the age they currently are. Okay. Children's policy. That's one thing I want to share with you. Two more things, and then we'll get ready to go. Children's policies, I think, are so huge, so important. Caleb and Miriam, I think, have two policies each, right? The reason why I personally believe children's whole life policies are important is because they guarantee insurability, right? No one wants to think about their children dying. That is like that's not the only thing that children's insurance does, right? I think that's what the general concept is, and that's why most people are like, la la la, I don't want to talk about children's insurance, but I think it's because we only think that it can be used for their demise. And that's not the case, right? Children's insurance policy is whole life, just like what we just talked about, that goes to age 120. That's number one. Number two is super inexpensive, but it guarantees their insurability. God forbid something happens to someone's child, when they're a certain age and they don't have insurance, then now that thing stays in their medical record and it might make them uninsurable, like a childhood cancer. Cancer diagnosis stay in the medical information bureau for 10 years, right? So let's say that they have insurance and they're already covered. You don't have to worry about their insurability, because whatever company they're with, they are, for the most part, and I know Mutual of Omaha is this way, and I know that Senior Life is this way. And I write with a bunch of different carriers. I'm a broker, so I work for you. I don't work for the carrier. I get to write for the carrier, but I get to shop for you, right? To find you what's best. So it guarantees their insurability. So if something happens to them health-wise, they can't be canceled. They can't be kicked out. And they can also apply for additional coverage with that same company, regardless of their health condition. Okay. So also, if you're someone that just say has had like several different things going on with your health, we cover everyone. There's policies that will cover people with HIV, with AIDS, with, different transmitted diseases. You can get coverage, cancer, you can get coverage, heart attack, cancers, and stroke, you can get coverage. Now, it may be a modified or a graded policy depending on the timeline, but you can get coverage, right? So don't not get coverage because you're like, well, I don't want anybody to know. That's okay. It's all confidential, right? No one's going to know anyway, but that's not a reason not to get coverage. Now, what else was I going to say? Oh, this I think is so important. Let me make sure I've said everything. How can you afford insurance? Cut out some unnecessary stuff. Y'all know it costs about $100 to eat lunch. Right? I'm just saying, cut out some things that you know are like, okay, well, I'm a little wasteful over there. Like, I'm wasteful on eating out. I'm wasteful on thrift shopping, right? So if there were some things I needed to cut out and be honest with myself, I would have to think about, okay, what can I cut out so that I could afford at least a baseline policy for my family and I to begin protecting ourselves, growing our wealth, protecting what we have. Because really it's about protecting what you have, right? Because if you're not here, what do your children do? Right? If you're not here and they're still young, what do they do to make up your income? It's impossible. But insurance can help make up their income, right? Having a plan in place can help make up their income. Okay. But this, I think, was a really great idea. And this probably was in a training that I took a few years back when I became licensed. This is about my fourth year now, right? But a family plan, get together and pay with your siblings and do the opposite and do a reverse crowdfunding. What is that? Crowdfunding is GoFundMe. It's like when you have to, collectively ask people outside of the family to help pay for the cost of a funeral, right? Or to help raise money for things that are needed. That's crowdfunding. But why don't we reverse crowdfund? Why don't we talk to the family, those of us that are close or have at least a couple of close siblings and say, or even if you only have one sibling, even if it's a step sibling or your husband's sibling or your own siblings or vice versa, right? Why don't we get together, you guys, and pool our money together and get a policy for mom and or a policy for dad and or a policy for grandma? Maybe you could put together $10 each and you all put it into an account and then you all use a debit or credit card or an ACH draft from that account to cover the cost of the insurance for the family member that you know is not insured, right? Everybody pool their money together collectively. And I know that may not be easy for every family. So I'm just throwing that out there for those of you that do have that type of relationship. Hey, why don't we get together and collectively get a policy on mom and dad? Now, what if mom and dad already have their own policy to cover their funeral? That's great. That means that when mom and dad pass away, you're going to benefit as a beneficiary because you can own the policy, right? Depending on the company, they may have to own the policy and you be the beneficiary. Just depends on how it gets set up. But I just think that's a really great idea. And then what happens after the funeral, right? So we think about getting insurance to cover funeral expenses, but who's paying the mortgage when everybody's gone? When that particular person is gone, how the kids and whoever's left behind, the wife or the husband, whoever the survivors are, how are they surviving? How's the mortgage getting paid? How's the daycare getting paid? How's tuition getting paid? How's college getting paid? So you want to think about all these things, not just burying someone, right? If you can afford it. And then last thing I'll share with you as we do retirement planning, right? And what I mean by retirement planning, I'm not a financial advisor, meaning we talk about and we can help our clients with index universal life policies. I will tell you if you have any type of, how do I want to word it? If you're not in the greatest of health, then you wouldn't qualify for an index universal life because it's real vanilla, meaning because it has a health component tied to it. But what can you do then? An annuity. right? So if you say, you know what, I really need to start preparing for retirement, it's not too late. Don't think that, right? Because again, people are living longer. So if you've been self-employed, you might not have had a retirement. Maybe, or maybe you had a Roth, or maybe you had a 401k, or maybe you had something where you're like, you know what, we need to look at that again and maybe see if we need to add something else or if we need to do something different, right? Now's the time to do that. There's nothing wrong with that. So I want to encourage you, you know where you are. But again, with an index universal life and with an index annuity, those are tied to the index. And what I like about those products is you're guaranteed against, you're protected against downturns in the economy or downturns in the index because you can't go below zero on the money that you put in, but you can earn over what the bank is currently paying because the bank ain't paying nothing on our money. Right now, they're making all the money off of our money, but the bank is probably what, a 0.5%, a point of percent. I'm making it up. I don't know what they're paying, but I know it's not a 1%. Right. So when you think about what can I do for my retirement, how can I get started? Just educate yourself. Just say, you know what, Garland, okay, if I was to put aside $100 a month, $200 a month, $300 a month, $500 a month, whatever it is that you already or want to put away for savings or for retirement, we can run complementary illustrations to say this is what your money can potentially look like. And then we can show you what it's guaranteed to look like. Guaranteed and potential never look the same. I will tell you that, but it will show you where you could potentially be in retirement or potentially be 5 years down the road, 10 years down the road, 20 years down the road. Nobody really likes to talk about this stuff because it seems like it's a little overwhelming, but really it's easy. We sit down, we talk, we go over everything. It's easy, it's simple to understand. And then once you have it in place, you don't necessarily set it and forget it, but you don't have to be burdened by worrying about it anymore. It takes pressure off. Does that make sense? So I just want to thank you all for joining me on tonight. I want to make sure, let me look at my notes right quick and make sure I didn't forget anything. Um, no, I think I got everything. Yep, that's everything. Okay. So how do you reach me? So this is Garlinda Price. For those of you that don't know, and I own Fusion Insurance Group. Again, I'm a licensed life insurance broker. What does that even mean? The difference between a broker and an agent. So as an agent represents one company. They can sell that company's product line. That's it. As a broker, you don't represent a company. You write for multiple carriers, right? And I can just name some of the carriers. I write for Senior Life. I write for American Amicable, John Hancock, Foresters, Transamerica. So many different carriers, and I'm licensed in multiple states. And I can get licensed in your state as long as it's not New York. I can't get licensed in New York. Most people can't, right? And I think maybe Iowa or Idaho. I can't remember, but I'm licensed in multiple states. So if you're like, Garlinda, I want you to talk to my family member, I want you to talk to me, give me a call. So I'm gonna put my number in the chat, but my phone number is 910-494-7798. I thought I was gonna put my number in the chat. Marvin, Puh, will you type my number in the chat for me? Type my number in the chat for me. Uh-huh. Hey, Pastor Sharon, God bless you. I have my Lammy typing the number, so he might not even know my number. Do you know my phone number? And I say that because when you call people all the time, that doesn't necessarily know that you mean that you know their phone number. Look at you, Lamb Chop. Okay, so I'm Garlinda Price, Fusion Insurance Group. My number is 910-494-7798, but I am licensed again in life insurance, health insurance, annuities, index universal life, index annuities, fixed annuities, you name it, we can do it. I don't do investment products though that require investment licenses, but index annuities, we can help you out. Super excited and honored to. And again, licensed in multiple states. We just helped a client. We just got licensed in Louisiana this month. We got licensed in Florida last month, but I mean, Maryland, Virginia, Georgia, South Carolina, Delaware, Pennsylvania, Michigan, Mississippi, Missouri. I think we got licensed in Missouri last month. There's so many states. So give me a call. I'll be honored to serve you. And then if you have any questions, put them here in the chat if you're watching the replay or come back to the replay, and I'll be sure to answer. So God bless you guys. I look forward to talking to you soon. And thanks again for being here with me tonight. I'll be honored to serve you and your gorgeous family. Okay. Bye. All right. Bye, YouTube. Thanks for being here tonight. Hey, Caleb. God bless you guys, and thank you for joining our Zoom tonight. I hope you were able to hear me. If not, I apologize, but I will repost the we'll post the replay.